Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can better understand what we see in the global landscape. You know, we have a garden variety sell-off in a few of the markets, not only here in the U.S., but also around the world. One of the things that I always try to educate not only my clients, but also our TV and radio listeners is, you know, mild corrections are essentially a natural part of the investing process. Nothing goes straight up and nothing goes straight down. The best way to explain it is really like walking up a set of stairs. You know, most people, you can't keep walking upstairs. At some point, you got to come down a step or two. So essentially what the markets are basically seeing is we've had a nice run up last year. We're seeing a little pause that refreshes. I don't see any more than that. Of course, if we do get indicators to raise more cash or get defensive, we will. We don't make knee-jerk reactions. We run a strict investment strategy, and that's important. And I think too often there's a lot of hype and hoopla from a lot of the TV shows, you know, that sell basic advertising, and hype and hysteria sells. And unfortunately, too many investors get tied up in this. At the end of the day, the U.S. economy looks like it's on stable footing, and it looks like it's getting a little bit better. We've had a few numbers in the last week that are a tad weaker than wanted to be. But essentially still in positive territory, meaning that the U.S. economy is growing. A lot of these little bit of pullbacks are basically pointed toward maybe the bad winter we've had in the U.S. And that's definitely a valid point. But again, nothing goes straight up and nothing goes straight down. So as the economy repairs itself from the credit debacle in 2008, what essentially you're going to have kind of a backfilling effect. You're going to move up. You're going to come back a couple steps. You're going to hopefully move up another 6 or 7 steps and come back a step or two. Again, this is the natural process. It doesn't just happen, by the way, in the stock market. It happens in all investment markets, whether it's real estate, gold, bonds. It really doesn't matter. In fact, we had a person or a client that called us up and was discussing with me moving his portfolio to our firm. He was primarily in bond-related mutual funds in 2013. He told me that he was down well over 9% on his portfolio in 2013, and he thought bonds were safe. And what I tried to explain to this individual, every investment that you buy, whether you think it's conservative or aggressive, has a degree of volatility and risk short term. If your goals and objectives are 1 month or what happens in the next 6 months or 1 year, you shouldn't be an investor. You should stick it in the bank, make no return on your money, and definitely lose out from inflation. You have to accept short-term volatility, I explain to this individual, and I explain this to every person that listens to my TV and radio show, and I really try to educate my clients on this. Because at the end of the day, what happens in the next quarter, 6 months, or year is not indicative of what's going to happen, in our opinion, over the longer term. Investors need to realize whether you're 65, you're 45, or you're 85. Unless you need to spend all your money today, what happens in the next month, 2 or 3 months is not indicative of your overall retirement strategy. So again, while the news programs like to sell advertising and they like to pump things up, a 2 to 5% movement down, whether it's in bonds, whether it's in gold, whether it's in stocks, real estate, or any asset, is really just a short-term movement. What we're looking for is major problems, structural problems in the U.S. economy and around the world. We're currently not seeing that. Of course, if those structural problems come to roost, we will basically get extremely defensive. We are somewhat defensive right now. In fact, we did sell our emerging market position, about a week and a half, 2 weeks ago, simply because it fell out of our top 5 ranking and it started to become relatively weak. It also had a technical sell level. So we basically offloaded that or sold it, and basically that money is sitting in cash. So I feel we have an ample amount of cash. That doesn't mean that we may not sell another position coming up. We're watching things, of course, closely, but we're not going to make knee-jerk reactions. In fact, I had a client ask me, Brian, do you use stop losses? How do we lock our portfolio at the top and then basically sell out before everything goes down? And what I tried to explain to this client is you can't sell at the top and then rebuy as this person indicated they wanted to do. I said, exactly when do you plan on doing that? These, again, 2 to 5% movements are commonplace. So what this person was alluding to or asking me is, hey, if my portfolio is worth $1 million, can I just sell it at that point, lock in that gain, and then re-enter the market? And I said, well, when are you going to re-enter the market? What's your game plan? And they basically said, I don't know. I thought that's what you do. And that's exactly what we do. So again, we're going to run a strategy. We're not going to make knee-jerk reactions. We're not going to get emotional. And again, When a client hires our firm, they realize we are looking at an average 3-year scenario or return on a portfolio. Again, what happens in the next quarter or month is not indicative, in my opinion, of what's going to happen over the next 3 years. Whether you're 65, 45, or again 85, as long as you're not going to spend all your money today, tomorrow, or next week, really the value overall, the short-term fluctuations are going to be commonplace. I want to talk a little bit about bonds last year, and this really hits home with one of my calls that I did receive that I talked about earlier. While a lot of investors in bonds were really taken to the woodshed last year, bonds have kind of stabilized a little bit and the rates have come down just a tad. Just like stocks or any other investment asset, bonds don't go straight down and they don't go straight up. In fact, if you look at bonds over the last year or so, they basically went down 4 or 5 flights of stairs, and right now they're coming up 1 or 2. I firmly believe as long as we continue to see progress in the economy and the world on improvement, we'll probably see rates back up again to somewhere in that 3+% range by year end. Again, this gives an opportunity to investors who are overloaded in the wrong type of bonds a chance to actually sell that position or sell those positions and maybe reallocate those into areas that will truly give you an opportunity. By the way, just to give you an idea, government treasuries by many investors are perceived to be one of the safest investments. If you understand bonds and government treasuries, which is a bond, but just through the U.S. government, long bonds last year dropped about 15%, negative 15% on the long government treasury. I'd say that's a pretty big risk. At the same time, a lot of equity markets were up around 15+%. So at the end of the day, what people perceive to be risk and what we look at reward is important, and you want to make sure you continue to follow investment strategy. If you're a client of Resney Wealth Management and you have a question, please give us a call. If you're not a client, maybe it's time you became a client. Call our firm for consultation. We always like taking on new clients who are nice people to do business with. Remember, I've got a live TV show this Sunday, and I also have a live TV show tonight, and a live radio show Sunday. If you're not in our viewing area for our TV show, it will be uploaded by noon tomorrow. You can go to our website, and we will send out a reminder. Make sure you have yourself a safe and profitable day.